This video is all about Market Linked GICs, an investment that's marketed as low risk with high returns. We're going to start by taking a closer look at what exactly these GICs are, some pros and cons that you should be aware of, and also some important things you should definitely know before you actually buy them. You've likely seen promotions through your online banking, or maybe you even saw a poster when walking into your bank or credit union promoting GICs offering rates well above what traditional GICs are paying. These GICs are commonly referred to as Market Linked or Equity GICs. So what exactly are they, and how do they potentially provide higher returns than your standard GIC? Basically, a market-linked GIC is a type of investment that usually tracks the performance of either an index or a specific basket of stocks. As an example, maybe you purchase a GIC that's based on Canadian banks. So how well those Canadian bank stocks do over the time frame that you own that GIC is going to determine what your rate of return will be. Similar to normal GICs, they are principal protected, so at least you know you won't lose any money. However, the amount of interest that you're going to get isn't going to be determined until the GIC actually matures, and that maturity date could potentially play a big role in determining how much you're going to make, and I'm going to show you why a little later in this video. Let's take a look at some of the pros and cons to owning these GICs. We already know that they're principal protected, so you can have peace of mind knowing that you can't lose any money. And even though your principal is guaranteed, you can still participate in stock market returns, giving you the opportunity to earn more interest than what traditional GICs are paying. This can be a great advantage when interest rates are particularly low. The good news is as well, they're usually eligible for most investment accounts like your tax-free savings account or your RSP, for example. Here is an example of a typical market-linked GIC that can be found at most banks and credit unions. And the first thing that catches my eye is that rate of return of 18.88%. So for an investment where I know that my principal is protected, who wouldn't be interested in that? So let's take a closer look. In this case, this GIC is based on two indexes, a utility and a bank index, and that eye-catching rate of almost 20% is actually for a term of only 3 years. And the good news is, no matter what, you can expect to earn a minimum of 2%. Now here's where it gets interesting. Generally, when we see rates promoted from banks, whether it has to do with GICs, loans, or even mortgages, they normally market those rates very clearly to consumers based on what you can expect to earn or pay on an annual basis. However, for whatever reason, these market-linked GICs are not marketed to us in the same way. If we actually take a closer look at the fine print, we can see that those rates are what you could potentially earn over the entire 3-year time frame, meaning that 2% guaranteed rate is actually only equivalent to about 0.66% per year. And that 18.88% rate is actually a maximum of 6.3% per year. Now, 6.3% is nothing to complain about when we're talking about GICs, but the point that I'm trying to make here is you really want to take your time, be thorough when reading that material, and make sure you know what you're getting into before you purchase one of these GICs. Considering what we've learned, are there any major cons that we should be aware of? Well, first of all, you can't access your money, so if you think there's a possibility that you might need access to that investment, do not buy that GIC. Secondly, that rate of return is going to be heavily determined on the maturity date, with no exceptions, and I'm going to show you what that means in a second. Third, it's possible that you could end up with a GIC with a 0% rate of return. What we're looking at here is a snapshot of historical returns from a 4-year market-linked GIC available at another institution. Now, most institutions will post their returns online, but if you can't find them, they will provide them when requested. And this is information I would be interested in seeing when deciding whether or not to move forward with one of these products. Now, in this case, an investor would have purchased this GIC and it would have matured in November of 2015. Unfortunately, it earned them 0%, which means they only got their principal back. Earning 0% on one of these GICs is usually the result of the following. Either the basket of stocks it was tracking did in fact earn 0%, or the markets went down and the return on these stocks would have been negative. Now, had they purchased this GIC 30 days later, it would have matured in December of the same year, so 1 month later, and instead they would have actually earned 8.7%. This is what I mean when I say that the maturity dates can have such a heavy impact on your returns. Had you purchased stocks in the stock market and the markets went down, then you at least could have waited for markets to rebound before you sold. But with market-linked GICs, you don't have that benefit. If markets are down when your maturity date hits, you are out of luck. So is this GIC right for you? Well, if you're looking for 100% principal protection, you're willing to forfeit what you could earn on a traditional GIC in hopes of getting a higher rate of return, and you know that you will not need to access this money, then this GIC is potentially a good option for you to at least consider and mix up your traditional GIC portfolio. This wraps up our video on Market Linked GICs. If you've ever owned one, I'm curious to hear your thoughts, so comment below and let me know. Don't forget to check out our new website, theindependentdollar.com. If you liked the video, please give me a thumbs up and hit that subscribe and bell button so you don't miss out on any future videos. Thanks for watching.